Structural engineers have this concept when they build a massive suspension bridge.
Right.
They can model the math, they can test the tensile strength of the steel, and they can simulate the wind. But they don't actually know the true limit of that structure until a Category 5 hurricane hits right at the exact same moment a fully loaded freight train decides to cross it.
Yeah, you get the chaotic reality of raw compounding pressure.
Exactly. Suddenly all those neat theoretical models are just replaced by chaos. So welcome to the week that was. In this deep dive into the source material, we are looking at a stack of intelligence and market data that is essentially describing that exact scenario, but, for the global economy.
It really is the ultimate systemic stress test. I mean, we are looking at a deeply interconnected financial and geopolitical architecture that's just being pushed to its absolute limits all at once.
Right. And our mission for this deep dive is to map out the mechanics of this massive squeeze. We're tracking an expanding conflict in the Middle East, a really counterintuitive divergence in how massive corporations are treating digital assets versus artificial intelligence, and a looming quantum computing threat to global cryptography.
Which sounds like a lot, but it's all connected.
It really is. And I want to state right up front to you, our listener, our goal today is solely to analyze the original source material. When we discuss international conflicts or statements from the executive branch or NATO, we are maintaining strict political impartiality.
Yes, absolutely.
We are simply reporting the facts, the data, and the statements exactly as they appear in the documents, without endorsement, without condemnation, and we're definitely not taking any sides.
And what's really fascinating about this particular stack of data is how these seemingly isolated events are just so deeply woven together. I mean, you might assume the physical price of a barrel of oil has nothing to do with, say, a computer algorithm hunting for stop losses in a digital asset market.
Right, they sound totally unrelated.
Exactly. But the causality between them is actually direct and measurable. We are witnessing a real-time test of the resilience of both our legacy fiat systems and our emerging digital systems.
Okay, let's unpack this by starting at the very top layer, the physical and economic world. Because this geopolitical pressure cooker is really the physical engine driving the financial volatility we see everywhere else.
It is the foundation of the whole storm.
Yeah. So looking at the military data, there is a clear expansion of what is being called Operation Epic Fury. We are seeing direct ballistic exchanges between Iran and Israel.
And we also have Houthi forces deploying new technology.
Right. They've deployed a new hypersonic missile designated the Palestine II, which reportedly travels at Mach 16 and maneuvers mid-flight to actively evade tracking systems.
Oh, wow.
Yeah, and furthermore, Russian satellite telemetry is actively being shared to coordinate some of these strikes.
We also have to really examine the shift in the nature of the targeting here, because the intelligence highlights recent strikes on critical civilian infrastructure, most notably Kuwait's desalination plants.
Which is just a massive escalation.
It is. When a facility that provides 90% of a nation's drinking water is targeted, the theater of conflict moves way beyond tactical military objectives. It becomes an existential threat to sovereign continuity.
And the economic panic that generates is immediate.
Completely immediate.
And while that physical infrastructure is under threat, the traditional security alliances meant to manage this kind of regional chaos they're experiencing internal friction.
Yeah, the NATO discussions.
Exactly. We have recent executive branch statements designating NATO a paper tiger and explicitly floating a U.S. withdrawal from the alliance, citing a lack of allied support in the Middle East.
But there is massive pushback on that.
Huge pushback. In the Senate, lawmakers are citing the 2023 National Defense Authorization Act, which actually legally requires a supermajority vote to leave the alliance.
And that potential political fracture, it doesn't just exist in a vacuum. It has massive immediate economic implications for Europe.
How so?
Well, if the U.S. security guarantee is removed, or even just seriously questioned by the market, European nations would be forced into trillions of euros of sudden deficit spending just to rapidly rebuild their domestic defense industrial bases.
Oh, I see.
And that kind of emergency deficit spending, it dramatically accelerates the debasement of fiat currencies across the Eurozone.
Which is colliding directly with a massive physical supply crunch happening simultaneously. The data points to the closure of the Strait of Hormuz, which effectively cuts off 20% of the global oil supply overnight.
20%, just gone.
Gone. We saw Brent crude spike to the $116 to $120 range, with U.S. gasoline hitting $4 a gallon.
And the response to that was pretty historic.
It was. The G7 and the International Energy Agency coordinated an emergency release of 400 million barrels of oil, heavily tapping into the U.S. Strategic Petroleum Reserve just to artificially suppress the price.
Right.
And right on top of this energy shock, we get the latest macroeconomic data. The U.S. labor print came in surprisingly strong. They added 178,000 jobs, completely blowing past market estimates.
And that specific combination, the energy shock meeting robust job growth, creates what Federal Reserve Chair Jerome Powell has called the inflation growth dilemma.
So let's break that dilemma down for the listener, because on the surface, it sounds contradictory. I mean, wait, if emergency oil is flooding the market to stabilize prices and job growth is strong, shouldn't traditional markets be thrilled?
You would think so, yeah.
Right. Why does this specific combination of events actually put a chokehold on risk assets, and specifically on digital assets like Bitcoin?
Because it fundamentally alters the cost of capital. You have strong job growth, which means everyday consumers are still earning and spending.
Yep.
But you also have a massive geopolitical energy shock pushing the baseline cost of manufacturing and transportation way up. So strong consumer spending plus high energy costs equals sticky, persistent inflation.
I get it.
Yeah, and because the labor economy isn't breaking down, the Federal Reserve has all the economic justification it needs to maintain a restrictive, higher-for-longer interest rate policy.
Which hurts digital assets.
Exactly. When the risk-free rate of return stays elevated, it dramatically compresses the valuation multiples of non-sovereign digital assets. Borrowing money remains incredibly expensive, and global liquidity just dries up.
Okay, so moving into the digital asset markets, we can see exactly how that dried up liquidity plays out, because these markets operate 24/7.
Right, they never sleep.
They never sleep, meaning they are the very first to absorb and price in these geopolitical and macroeconomic shocks. The market data shows Bitcoin hovering in the mid-$60,000 range, caught in a regime of what analysts are calling microstructural exhaustion.
Which is a very technical term.
Yeah, so in plain English, what does microstructural exhaustion actually mean?
Well, it basically means the order books are empty. There is no new buyer demand stepping in to hold the floor. Yeah, the institutional capital has just paused, leaving the current price structure incredibly fragile and highly susceptible to sudden, violent drops.
And that fragility triggered a brutal cascade. We are looking at a mathematical liquidation event where hundreds of millions of dollars were wiped out in a matter of hours. Over 140,000 individual traders had their accounts forcibly closed.
It was a massive leverage flush.
Yeah, and the raw data shows the vast majority of those wiped out were holding long positions. These were retail traders who heavily over-leveraged themselves, anticipating diplomatic resolutions or ceasefires in the Middle East that just never materialized.
And this is where the mechanics of the market get highly predatory.
Here's where it gets really interesting.
Yeah, because high-frequency trading algorithms are specifically designed to recognize this exact setup. They can mathematically detect when there is a lack of macroeconomic conviction, when the big buyers are exhausted.
Right.
When these algorithms see that the Federal Reserve isn't going to cut rates, and they see a massive cluster of retail traders over-leveraged on the long side, they go to work. They intentionally widen the bid-ask spreads and pull away their buy orders.
So it's like a game of musical chairs, but the music is entirely controlled by oil prices.
But let me ask you about this stop-loss hunting. Are algorithms genuinely manipulating the microstructure to wipe out retail traders, or is this just standard market panic?
It is intentional. They drop the floor of the market to trigger those retail stop-loss orders, forcing a cascade of automatic selling.
So they pull their buy orders, trigger the avalanche, and then scoop up the liquidated assets at the absolute bottom.
That is the exact mechanism. And it's not just retail traders getting caught in the volatility. In the first quarter, we saw a deficit of roughly $500 million in ETF outflows.
Wow.
Yeah, institutional allocators are actively rotating their capital out of digital assets and into treasury bonds and analog commodities as they price in this persistent inflation, which indicates they aren't treating Bitcoin as a sovereign hedge or digital gold right now. They are treating it like a hypersensitive tech stock.
Exactly. When global liquidity tightens, they dump it.
Now, this financial squeeze isn't just shaking out retail day traders. It is fundamentally altering how massive corporate treasuries operate, revealing a massive split between Western and Asian strategies.
Yes, the corporate divergence is fascinating. In the West, we are seeing a structural capitulation really driven by the AI boom.
Let's look at the corporate miners as the prime example. Bitfarms, which is a massive publicly traded Bitcoin miner, completely rebranded to Keel Infrastructure. They announced they were liquidating their entire treasury of 2,400 Bitcoin.
Which is a huge pivot.
Huge! And the reason why is crazy. They're using the capital to physically retrofit their air-cooled crypto mining sites into liquid-cooled data centers, specifically designed for artificial intelligence computation.
And Riot Platforms followed a similar trajectory. They sold more than double the amount of Bitcoin they actually mined recently just to fund their operations and infrastructure upgrades.
And beyond the miners pivoting to AI, you have the entities that are simply crushed by the macroeconomic environment we just talked about.
The debt casualties.
Exactly. The filings show Genius Group dumped their last 84 Bitcoin onto the open market just to service their fiat debt. And Nakamoto Holdings liquidated 284 Bitcoin at a massive 40% loss, solely because they couldn't sustain the crushing interest burden of a traditional fiat loan.
But then you look to the east, and the strategy completely inverts.
Right.
Japan's Metaplanet aggressively acquired over 5,000 Bitcoin in the first quarter alone, bringing their total corporate reserves to over 40,000.
Which is a staggering amount.
It is. And what's crucial here is the mechanism. They aren't just buying it on the open market with cash. They are utilizing a highly sophisticated financial engineering model, specifically a collateral-secured put option strategy.
Okay, hold on. Let's break that financial engineering down for the listener, because that sounds incredibly dense.
Sure.
They were essentially selling insurance on the price of Bitcoin, collecting the cash premiums from that insurance, and then using that free cash to buy more of the underlying asset.
Precisely. By selling put options, they agree to buy Bitcoin at a lower price if the market drops. For taking on that risk, they are paid a cash premium up front.
Okay.
They take that premium yield and recycle it right back into purchasing more Bitcoin today. It allows them to accumulate the asset continuously without constantly raising new fiat debt.
So what does this all mean? It feels like the West is melting down their digital gold to build silicon brains for AI, while the East is just quietly hoarding the gold.
That's a great analogy.
But let me push back a bit. If miners, the very people securing the network, are selling off their product to chase the AI trend, doesn't that signal a fundamental lack of faith in the asset?
I wouldn't call it a lack of faith. It's thermodynamic and financial reality. When capital is expensive, leverage destroys you. Western firms are heavily burdened by fiat loans, and the thermodynamic cost of energy is spiking.
Right, because of the Middle East conflict.
Exactly. It's pushing their profit margins into negative territory. They have to sell to pay their traditional lenders or pivot to AI to survive. Meanwhile, Asian firms with cleaner balance sheets are demonstrating how structural, long-term accumulation happens when a corporate entity is free of crushing debt.
So human institutions and corporate miners are struggling under the physical weight of debt and energy. But the software itself, the actual code underpinning this entire digital economy, is facing its own existential survival test.
Yes, the technical horizons are shifting rapidly.
In the latest stack of research, Google dropped a bombshell white paper stating that quantum computers could break elliptic curve cryptography by 2029.
Which is right around the corner.
Yeah. This is the very mathematics that secures Bitcoin and most of the modern internet. They estimate it would take under 500,000 qubits to achieve this, putting millions of legacy coins at direct risk of theft.
To understand the severity of this, we have to look at how the math works. Elliptic curve cryptography relies on a mathematical trapdoor. It is very easy to multiply two massive prime numbers together.
Right.
But it is practically impossible for a classical computer to look at the result and factor it back into the original prime numbers. It would literally take thousands of years.
Okay, so what does a quantum computer do differently?
Well, quantum computers use something called Shor's algorithm. They don't just try one combination at a time. They leverage quantum mechanics to process vast probabilities simultaneously, turning a 1,000-year math problem into a 10-minute exercise.
Wow. But the developer network isn't just waiting around for the lock to be picked, right?
No, definitely not.
The technical updates show the launch of the BIP 360 testnet. This introduces a mechanism called pay-to-Merkle root to transition the entire network to quantum-resistant security models.
And the elegance of the pay-to-Merkle root upgrade is in its simplicity.
How does it work?
Currently, when you receive funds, your public key is somewhat exposed on the ledger. This new mechanism essentially hides the user's public key completely until the exact moment a transaction is spent.
Oh, I see.
Yeah, so by the time a quantum computer can even see the mathematical lock, the transaction has already cleared and the lock is gone. It gives the quantum machine virtually zero time to crack the math.
But implementing that is a monumental task. I mean, upgrading the fundamental cryptographic algorithms while the network is running 24/7, it is literally like changing the vault locks while the bank is completely open for business.
With billions of dollars flowing through the lobby.
Exactly. Every single node operator has to adopt the new rules without fracturing the system. And while they're hardening that base layer against quantum threats, the application layer is evolving in ways that sound like pure science fiction.
You are referring to the automation of the settlement layer.
Yes, the launch of the Buy 402 Foundation, backed by major institutional players like Coinbase and Stripe. They are creating a standardized internet payment layer specifically designed for autonomous AI agents.
Right.
This allows machines to settle stablecoin transactions with other machines entirely without human authorization. But wait, with the Buy 402 Foundation letting AI agents settle their own payments, aren't we just handing the financial keys over to the machines?
It feels like that, but it is a necessary evolution. Legacy banking simply fails artificial intelligence.
Why is that?
Think about it. If an AI agent is renting server space or negotiating data access with another AI by the millisecond, it cannot wait 3 to 5 business days for a traditional bank transfer to clear.
Oh, right.
It requires cryptographic settlement that matches the speed of its own processing. Stablecoins running on blockchain rails become the native instantaneous settlement layer for a machine-to-machine economy.
And the regulatory rails are being laid for this at the highest levels, too. The filings note that Coinbase just secured a national trust charter from the Office of the Controller of the Currency.
Which is massive.
It is. So they are building the fully compliant federal legal rails for institutions on one side, while simultaneously building the automated, frictionless rails for AI on the other.
But what is perhaps the most counterintuitive data point in this entire stack is about ultimate physical resilience.
Oh, the radio network transaction.
Yes. In the midst of all this high-level network evolution, a developer in India successfully executed an off-grid Bitcoin transaction using Meshtastic LoRa radio networks.
That's incredible.
They broadcast the financial transaction and achieve consensus without utilizing any internet infrastructure whatsoever.
It is the ultimate test of decentralized resilience.
It really is, and there is a certain poetry to it. As physical power grids and vital desalination plants are being targeted in geopolitical wars, developers are proving that financial continuity can survive via simple localized radio waves bouncing between battery-powered nodes.
It is a stunning contrast. So let's quickly recap the journey we mapped out for you today. We started by looking at how expanding geopolitical conflicts in the Middle East and the closure of key maritime straits are creating massive physical energy shocks.
Right.
That energy shock feeds into persistent inflation, forcing central banks to keep interest rates high. That higher-for-longer policy squeezes global liquidity, which triggers massive liquidations in 24/7 digital markets, wiping out over-leveraged retail traders.
The cascade effect.
Exactly. Then, the compounding pressure of expensive fiat debt forces Western corporate miners to capitulate and pivot to AI, while debt-free Asian firms quietly accumulate using advanced option strategies.
And beneath all of this chaos, the code is evolving.
Yes, testing quantum-proof encryption and building instantaneous payment rails for autonomous AI agents.
It is a profound amount of systemic pressure. And, I want to leave you with a final thought to ponder as we wrap up this deep dive into the source material.
Go for it.
We just discussed how autonomous AI agents are being given the tools to instantly settle their own financial transactions. We are seeing the network actively transition to quantum-proof cryptography. And we've seen proof that these systems can run completely off the grid using localized radio waves.
Right.
So the ultimate question is this. At what point does this emerging digital economy become completely and permanently detached from the physical geopolitical conflicts of humans? If the machines are paying the machines on a network that can survive an internet blackout and adapt to quantum computing, do the physical borders, the debt cycles, and the ballistic missiles even matter to the system anymore?
That is a staggering thought. If the suspension bridge can survive the hurricane and the freight train, maybe it eventually doesn't need the ground beneath it at all. Thank you for joining us for the week that was. As always, keep questioning the narratives, look closely at the math, and stay curious.